Hi, this is Professor Cataldo, and this week was interesting. This last week, it is now December 2nd, so the last week in November 2018 was interesting. And the first thing I learned in my macroeconomics course was don't fight the Fed. And Macroeconomics, I am working on a macroeconomics textbook. It's going to take some time. It is covered in the BEC section of the CPA exam. And so, if you're an accounting major or a finance major or a business major, this might be interesting to you. But all you have to remember is all assets are financed with debt or equity. A equals L plus OE. And I pulled this off the CNBC website. I watched the business news there. And this is the forecast that they had a few months ago for the Fed funds rate. This is a January survey, and as you can see, they're increasing. And what we have here is an example of what happens when the Fed tightens too quickly, perhaps. You have a nice historical view of a lot of crashes, if you will. Now, over on the far right in orange, I have a little area. That's the housing crisis. So during this period from about 2008, 2009, when the housing market crashed, that's when the Fed reduced rates below let's call it a natural level. They kept interest rates way down, effectively providing free money to financial institutions to get us through this housing crisis. Well, we're out of it now, and we had something called the Trump rally, whether you like him or not, right after the November election for president. The stock market really started to take off. Now, that's equity, right? That's the equity market, the stock market. Why did the stock market go up 2.5% in one day? Well, because folks were predicting that the Fed would continue to raise their interest rates, and they thought that was going to put downward pressure on equities or stocks, the stock market. But once that chairman came out and suggested that they might consider a pause on raising these interest rates, and you never fight the Fed because they have unlimited resources, all of a sudden we got an overreaction or a pop in the equity market stocks. So it's either debt or equity, right? It's either invest in an interest yielding instrument, could be corporate bonds, could be treasury securities, could be anything, certificates of deposit. I can either invest in debt or I can invest in equity. A equals L plus OE. Just building a little on something you already know. You've already learned this in all your introductory business courses. Thank you.